This trade is a little nuanced, but it perfectly shows how market structure, supply and demand, and precise execution can create a clean 3R opportunity. In this breakdown, I'll show you how I waited for key liquidity to be taken, how I confirmed seller control on the lower time frame, and how I managed risk as price moved in my favor. As a reminder, this is for educational purposes only and not financial advice. Let's jump into the chart. Now, this is a backtesting example, but the same principles apply. If we rewind back to the 9:30 open, we can see that we're currently bearish on the 15-minute. We have a swing high and then a swing low right down here. If we use our Fibonacci retracement tool to cover the trading zone, we can see where the 50% line is. It coincides pretty much exactly with London high here, which is a key takeaway. This tells us that the London high places us in the premium of the selling leg. This time, instead of focusing on a fair value gap, I'm focused on this cluster of orders right here. This is a potential resting area for sell orders. At this point, what I want to see first is a liquidation of London high, some type of entry signal that sellers are in control so that I can seek lower prices. If we move forward in time to 10 a.m., we see exactly that, a liquidation of London. It's at this point that I would drop down to the 1 minute. Here on the 1 minute, we can see the liquidation that we saw on the 15-minute chart. On top of that, I'm looking for a demand zone that pushed price to take London high. For me, it's this sell to buy candle because it created a displacement and an aggressive move up so far that it took this local high here. This displacement is proof that there is demand sitting at this level. If sellers are truly in control, that demand zone should not hold. And we get exactly that, an aggressive displacement to the downside, which closes below the demand zone we had identified. Demand has been overrun. That's confirmation for me on an order flow shift. And now it's all about execution. We can see that there are two fair values created on the 1 minute that could provide viable entries. While I do like to look at the 5 minute for entries, in this case, the 5 minute doesn't provide me with a viable entry. So I'll stick to the 1 minute and notice this inverted fair value gap that's been created by this aggressive move down. That becomes my entry. Stops go above the highs, and for targets, I'm looking at two take profit zones. The first is this cluster of candles here, and the second is my ultimate take profit represented by this accumulation of orders where resting buy orders could be sitting. That's my final take profit. Ultimately, this results in a 3.69 R trade. As we advance forward, price tags us in and eventually hits PT1. I'll take partial profits immediately. But now here's the nuance. There's still inefficiency above, inside my drawdown. So instead of instantly moving to break even, I trail my stops down just above this fair value gap. This leaves just enough room for price to mitigate before continuing. From that point on, price melts and hits my final take profit. This trade reinforces something important. Wait for liquidity to be taken. Wait for lower time frame structure to align to your bias. Execute at inefficiencies and manage risk dynamically, not emotionally. This wasn't prediction. It was structured patience. If this breakdown helped you see market structure, I post backtesting and live trade reviews like this every week. Check out this next video where I break down another setup in detail, and I'll see you in the next one.